think Bitcoin will be somewhere between 40 and 55,000 for the next chapter.
We're going to be spending a lot more than Netflix. Right now, it's between the two of us, we're spending $20 billion a year on content.
We reopened this year. That may also put, and indeed in the CPI report, it did clearly put upward pressure on prices. Most of this is likely to be transitory.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, and here's what's coming up on today's program. Mike Novogratz tells Bloomberg that Bitcoin will be pressured for weeks amid Musk's induced mayhem. This as Michael Burry makes his latest big bet, this time against Tesla. Stocks are positive, but investors keep an eye on the virus. Japan's economy stalls. This year's WEF meeting is off, and the UK battles the India variant. And the race for content, Amazon is reportedly in talks to buy film studio MGM, home of the James Bond franchise. It'd be the biggest push into entertainment yet. Well, good morning, everyone. Last night, of course, was the final deadline for hedge funds to file their 13Fs. It gives us a glimpse into the moves by major hedge funds during the first quarter of 2021. A hectic quarter marked by Reddit-fueled trading and the implosion of the family office Archegos Capital. Let's get straight to the highlights now with our Danny Berger. Hi, Danny. Any really big themes that most funds seem to be playing on last quarter?
Yeah, Francine, we definitely saw a pretty sizable shift in attitudes when it comes to tech and sort of the stay-at-home play. Now, it didn't really do as well as the broader benchmark in the first quarter of 2021. So this is something that hedge funds not only would have profited on, but probably contributed to it. So two household hedge fund names, we had Coatue and Whale Rock, both reduced their holdings in these three stocks. So I have to say, Peloton, CrowdStrike, Zoom, these are ones you really think of in that stay-at-home play. Now, we don't know if it's because this is a reopening trade, this is a reflationary trade, or it's concerns about valuations, but they did make the bet. Now, speaking of valuations, one of the bets that's sort of gotten a lot of traction, a lot of interest, is this one of Michael Burry from Big Short fame. Now, he's been outspoken about his dislike for Tesla before, calling the valuations preposterous. In December, he deleted a tweet, but at one point was saying that he was short Tesla. Well, in the 13F filings, we learned of a lot of puts he put on the company Tesla. So, of course, these are bearish options on about 800,000 Tesla shares. Now, because of the opacity, we don't know when he put it, how much money he would have made from it, but it stands to reason that he probably would have made money considering Tesla lost about a quarter of its value in the first 3 months of the year, Francine.
So, Danny, if tech is one side of the trade, how did hedge fund managers actually treat more cyclical parts of the market?
So this one was a bit more mixed, and I specifically for this, Francine, want to concentrate on Warren Buffett because he's kind of an interesting take for sort of the zeitgeist of the market. Now, he continued to trim his bank holdings, specifically Goldman, JPM, and Wells. This is something he's been doing for a while. So this kind of is within that theme of preparing for lower interest rates for longer, more easy monetary policy. I mean, we did even just hear from Clarida yesterday saying that they should not yet pare back bond buying, but he did buy more Bank of America shares. He's really been building a big position around that. So that would seem to suggest that Warren Buffett is still betting on sort of the American consumer, that sort of retail story of that section of the economy coming back, Francine.
Danny, thank you so much. Our Danny Berger there with the very latest on these filings. Now, the race for content is on just today after Bloomberg broke the news about the biggest media merger in years, AT&T's media assets and Discovery. Now there are reports that Amazon is making its biggest push into entertainment so far. Reportedly, the world's largest online retailer is in talks to buy the famed MGM studio, the company behind the James Bond series. According to Variety, Amazon could pay about $9 billion. MGM would help bolster Amazon's Prime streaming services. Well, joining us now for more on this is Matt Bloxham, who covers media for Bloomberg Intelligence. Matt, great to have you on the program as always, and good morning to you. How will a possible MGM acquisition help Amazon's streaming service?
Yeah, hi, Francine. I mean, I think obviously, with the streaming rivalry heating up, you need to keep your content fresh. You need to keep having new content come through, which is going to keep your existing customers, bring new ones in. And so I think, adding MGM to the stable will definitely give them a stream of, not just kind of back catalogue of well-known films, but new content coming both on the film and the TV side. And obviously, one of the big standouts is potentially the kind of long-delayed James Bond film, which is due to come out cinematic release in October. Maybe they'll shift that if they do this deal and put it onto the streaming platform. But it beefs up the content as everybody else around them is continuing to spend billions of dollars on content and merging.
So, Matt, should Netflix and Disney actually be worried about this Warner Media Discovery tie-up?
I think they probably won't be worried, but they'll definitely be respectful of it. I think one of the big differences for me is that, Netflix has a very, very clear brand, certainly outside of the US, well known, similar with Disney. What you've got with Time Warner or Warner Media and Discovery is, 2 or 3 fairly well-known brands, but perhaps not quite got the clarity outside of the US, and international expansion is going to be key for them. So I think probably one of the biggest challenges for that new business is to kind of create a clear anchor brand outside of the US that's going to really kind of rival the clarity that Netflix and Disney have with customers.
Matt, we also heard about this TF1 M6 deal at the start. Could it be the start of TV mergers in Europe?
Yeah, I think it is, and we're seeing that in a couple of different ways. And also, this is an in-country deal, and I think there were some question marks today about, how easy a passage that's going to get through antitrust because of the dominant position that we'll have in audience share and TV advertising. But we've already seen that Mediaset, the Italian broadcaster, is planning a few moves to facilitate some cross-border M&A going forward. So I think, given what we're seeing in the broader streaming landscape, the pressure on advertising-funded TV businesses, the need to invest in streaming technology, to invest in content, all of these European broadcasters are too small on their own. And I think we are going to see over a number of years a series of deals to create perhaps 2 or 3 much stronger groups, both from a technology and a financial perspective. So yeah, watch this space in Europe. I think there's going to be a lot of deals that happen.
Matt, thanks so much. Matt Bloxham there from Bloomberg Intelligence, watching the media space. Now, coming up, Smart Conversations on Bloomberg Surveillance Early Edition. We'll talk appetite for M&A, inflation, commodities, and cryptos with John Normand, head of cross-asset fundamental strategy at JPMorgan. Now, if you want to take part in the conversation, just IB us. You can IB plus TV Go or IB me directly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. President Joe Biden has told Prime Minister Benjamin Netanyahu that he would support a ceasefire between Israel and Hamas. It is a shift in the U.S. approach following days of rising criticism for not taking a stronger stance. It adds to pressure to end the violence that has so far killed at least 220 people, mostly Palestinians living in the Gaza Strip. Meanwhile, President Biden says the U.S. will share at least 20 million doses of authorized COVID-19 vaccines with foreign nations by the end of June. It'll be the first time the White House will release doses abroad that could have been used domestically. It's on top of the 60 million doses of the AstraZeneca vaccine that hasn't been approved for use over in the U.S. After devastating India's biggest cities, coronavirus is now hitting rural parts of the country, and many of the villages have no way to fight the virus. Some have no healthcare facilities, no doctors, and no oxygen. Some rural citizens say they feel they have been left behind by the government to fight the pandemic alone. Many believe the scale of the crisis is much bigger than the official numbers do suggest. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now let's get back to one of our top stories, and it's been a week for M&A, a big week, and it's only Tuesday. AT&T and Discovery are set to merge media assets. Amazon is reportedly looking at taking over iconic film studio MGM, and in France, Bouygues and RTL are in talks to merge broadcasters TF1 and M6. Now let's talk the landscape for M&A in these markets and what comes next. Joining us is John Norman, JPMorgan Head of Cross-Asset Fundamental Strategy. John, I don't know whether, good morning, first of all. I don't know whether this is symptomatic of media deals because there's a fight for content, which is now kind of coming to the forefront, or whether in general we're going to see consolidation because funding is cheap and that will sway markets.
Well, I think it's both, and I think it's much broader than media, meaning there's always a strategic interest by companies in pursuing certain deals, whether it's for access to other markets or newer technology or to pursue consolidation in an industry. But certainly you couldn't pick a more robust macro environment for executing these transactions, basically because the funding costs are very low and equity prices are pretty close to all-time highs. So every part of the M&A sort of backdrop is working, whether it's the strategic side of things or the macro side of things.
John, I know we'll talk about inflation in a second and bond yields, but as we could get closer to about inflation, that could maybe mean that markets realize that there will be some kind of normalization of central bank, certainly the punch bowl. Does it spur M&A even more, or is it just part of the cycle?
Well, I think there's always some discussion that maybe companies are pursuing deals preemptively ahead of some sort of anticipation of tighter funding conditions to come. But I think we're so early in the business cycle, so early in the earnings cycle, so early in the Fed cycle that I don't believe anything that happens over the very near term is really going to be a huge derailer to what's happening in terms of corporate activity. If we were at a higher starting level of funding rates, if the Fed were on the cusp of moving from neutral policy to restrictive policy, if we were close to a big rollover in earnings growth where it went from above trend to below trend, then I think you could say the macro forces would be turning against the M&A dynamics. But I just, in general, feel like we're quite early cycle in terms of most things that affect corporates.
John, overall, why is it so difficult to forecast the path of the U.S. economy right now?
Well, I think it's much more difficult to forecast the path of inflation as opposed to the path of growth. I think we're pretty confident that there's so much stimulus and so much pent-up demand in the U.S. that it would be easy to get above trend growth for a couple of years. We may be off on exactly the quantum of growth, the magnitude or the pace of the increase, but I think it's pretty safe to say it's going to be above trend for a while. The inflation story, I think, is much more difficult because we are dealing with an unprecedented situation. That's a reopening effect in the context of some supply bottlenecks. And even though everyone's been correct that these shortages would appear and everyone's been correct that there have been unusually large price increases, no one's been correct on magnitude. I'm not too worried about that because I feel like when you look at these sectoral supply constraints on a case-by-case basis, there's a good reason to believe that many of these are going to be alleviated in the next 6 months. But as far as what the right forecast should be point-wise for the next 6 months, I think this is much more uncertain.
Well, I mean, I know you've had some, I guess, some new cross-asset strategy kind of, trades that you want to put on. Is there anything that's changed in the last 2-3 months, John, on how you look at the markets or some of these new trades?
Well, I think the main thing that's changed is just levels, and that may sound like a very glib comment, but the point is that if you try to hedge inflation and you realize that in break-evens are close to decade highs in tips, if you recognize that a lot of commodity prices have gone up, you may not want to favor some of the same trades to hedge inflation that you did a few months ago. So at current levels, given how much markets have already moved in the first 5 months of the year, I still feel like the best inflation hedge is a sector within commodities, i.e. oil, as opposed to the very elevated prices that you already see in base metals and in agricultural commodities. I don't think there's a whole lot of value in tips given how much the break-evens have rallied over the past several months. By contrast, I do think there is some value in some of the emerging market commodity currencies because not only have they failed to respond fully to the move up in commodity prices, but the carry on these has increased because of central bank tightening over the past few months. So you can make some minor rotations within the basket, but frankly, I think the whole of the basket of real assets is still going to keep climbing this year.
Yeah, and actually I want to get back to commodities in a second and maybe tie it in with China, and we'll talk about whether crypto is a good hedge against inflation, if it is at all, John. But what's your take on Europe right now? Is there any value in equities because, the vaccination process meant that maybe some of these markets were maybe sold off more than expected?
Yes, I think there's a minor catch-up trade in Europe. I wouldn't call it a major one because the equities have pretty much kept pace with U.S. equities over the past 5 months, and the euro has rallied as real rates have come off in the U.S. So I don't think there's a massive opportunity, but for choice, I'd rather be overweight Europe versus the U.S. In an equity sense, thinking that the reopening is going to deliver as big a growth boom and maybe as big an earnings boom in this part of the world as you're seeing in the U.S., even though the U.S. is the economy which is pouring more fiscal stimulus on domestic industry. So that's probably something that could persist for maybe the balance of the year. I'm not sure I'd stretch it into 2022 simply because the U.S. is going to have additional fiscal stimulus coming online progressively next year, whereas Europe probably will not. But for the next 6 months, yes, I'd rather be overweight Europe versus the U.S.
John, thank you so much. John Norman there of JPMorgan stays with us. We'll talk a lot more about commodities and the commodities rally picking up pace again. Copper rising on fears that supply from Chile could get tighter. We'll discuss all of that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the global commodities rally continues as surging demand for materials pushes supply chains to the brink. Copper rises towards a record following news that miners in Chile face tighter regulations. Now, Brent crude has hit $70 a barrel for the first time since March. We're back with John Norman of JPMorgan. He's still with us. John, we were talking, thank you for staying with us. We were talking a little bit about commodities before, but is there anything in the markets overall that you think is in bubble territory or that will warrant a correction in the next couple of months?
I don't think any asset classes are in bubble territory, meaning if you look at broad equity indices, if you look at credit indices, none of those to me are experiencing this combination of extremely high valuations and extraordinary momentum and very large investor leverage. When you look at the sub-asset class level, if you look at particular themes within equities, if you look at some single name stocks, if you look at newer asset classes like crypto, I think you can tick a few more of those boxes. And I believe that's why, as you've seen rates rise even minimally over the past month, you've seen these higher valued names and newer asset classes deflate somewhat. Importantly, though, if you're thinking, will there be a systemic consequence to the deflation of some of those smaller, expensive markets? I don't think so. I think the systemic consequence would come only if you believed that the overall equity markets were in a bubble or the overall credit markets were in a bubble, and I don't think that's the case. So there's still ongoing vulnerability as rates rise this summer. I think that rate rise is going to come because the Fed is going to change its messaging around tapering. This is going to put more pressure on the expensive parts of the equity market and some single name stocks as well as crypto, but I don't think this is going to pull down the overall broad markets very much.
What will crypto actually become? I don't know whether it's Bitcoin or something else, but will we see something emerge that's greener and more widely used, or does it always stay in this space where we don't exactly know, where it goes really from day to day?
Well, I think because the starting point is that there's a lot of interest in private digital money, there will be an ongoing attempt to come up with a better form of it over the next few years. And Bitcoin was sort of the forerunner. Its sort of lack of ESG compliance has been revealed and is becoming increasingly appreciated, but there are other crypto assets which don't have that. I do think there's a much more fundamental question here is what's kind of the intrinsic value of private money. For me, money has always been around the utility of a medium of exchange, which is universally accepted within a certain economic region. And because none of these cryptocurrencies will ever be legal tender, I think that the use case is somewhat suspect. So I understand why there's a constant sort of attempt to find a better form of money, but I really feel like this lack of legal tender status is always going to limit the utility, and it always questions what the use case is over the long term.
John, we have a couple of questions actually from viewers for you, and thank you for everyone sending them in. Please continue sending all the questions for our great guests. So this person writes in, John, and says, everybody knows there's a huge stimulus in the U.S. and growth should be above trend for the next 2 years. So should this not already be reflected in the level that the S&P has today?
I think the growth story for the next 18 months is already in the price, meaning if you think about where earnings expectations are for 2022 and you apply a multiple like 20, that kind of gets you to the level that the S&P is at right now. So from that perspective, yes, it's in the price. But remember, the business cycle is not stopping in 2022. It's going to go beyond that. And I don't think it's entirely unreasonable for markets to price in something reflecting several years of strong earnings growth rather than just the next 18 months. So the person who was posing that question is 100% correct. I'd say the near-term story definitely in the price, but because the cycle is going to go on for quite a while, this is generally what sustains these high valuations.
John, very quickly, is there something that would propel it higher?
Well, I think just the persistence of above trend growth, because we simply observed that the longer growth stays above trend, the more, and policy rates stay below average, the more asset price inflation tends to be created. And maybe that is just a foolish extrapolation bias that investors and analysts have, but it's nonetheless a pretty consistent sort of feature of financial markets. So I think as long as we're in this sort of regime where policy is accommodative, where growth is above trend, you're going to see drift. You may not see, or you will not see as much drift going forward as you've seen over the past year, simply because the starting level of PEs is higher, the starting level of spreads is a lot lower. But I think higher is the path.
John, thank you so much. John Norman, as always, Smart Conversations. He is JPMorgan Head of Cross-Asset Fundamental Strategy. Coming up next, we continue looking at the economy and vaccines. This is Bloomberg. Well, Mike Novogratz tells Bloomberg Bitcoin will be pressured for weeks amid Musk's induced mayhem. This as Michael Burry makes his latest big bet, this time against Tesla. Now, stocks are positive, but investors keeping an eye on the virus. Japan's economy stalls. This year's WEF meeting is off, and the UK battles the India variant. And the race for content, Amazon is reportedly in talks to buy film studio MGM, home of the James Bond franchise. It'd be its biggest push into entertainment yet. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. As you mentioned, Amazon is reportedly in talks to buy movie studio Metro-Goldwyn-Mayer. That is according to the Information and Variety. It would be the e-commerce giant's biggest push into entertainment yet. Variety says the deal could value the company behind the James Bond films at $9 billion. MGM and Amazon declined to comment on these reports. Now, half a dozen senior bankers at Credit Suisse have left the firm in recent weeks. They are the latest in a raft of defections following the implosion of Archegos Capital Management. The Swiss bank was the biggest loser from the collapse of the firm, writing down $4.7 billion. It has slashed the money set aside for bonuses to limit the financial hit. Heineken is in talks to take over South African wine and spirits maker Distell Group. It would be the most significant transaction since 2018 for the world's second largest brewer. Distell has a market value of about $2.3 billion. South Africa is one of Heineken's biggest performing markets. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, it was meant to be the world's safe haven, but WEF organizers are canceling their plans for a summit in Singapore after a recent uptick in cases. The spike comes at the same time as Taiwan is seeing rising infections and India's COVID crisis is heading deeper into rural heartlands. Now, as Western economies look to reopen, the outbreaks in Asia highlights the disparity in vaccination levels. Well, joining us now is Louis Costa. He's Citigroup Managing Director and Head of CEMEA FX Strategy. Louis, really with the best title in town. Thank you so much for joining us. When you look at some of the vaccination levels in some of the emerging markets and the resurgence, of course, of variants, I mean, the horrific situation in India, some of the concern in Brazil, what does it actually mean for what kind of recovery we'll see from the countries hit most by COVID?
This is a huge warning sign for investors, Francine, that there's still a huge divergence between vaccination rollout and the possibility to raise mobility curves, right, as these economies come out of restrictions in developing markets if compared to emerging markets. And you mentioned Singapore, you mentioned Taiwan. These were economies that, up until a month or 2 months ago, we were all believing that they were, absolutely fine, that they won the battle. And we know that, in some of these economies, they are actually, going through a few spikes, regional spikes, localized spikes, we have to say, but they are going through spikes. These are economies that actually, did reasonably well in terms of vaccination rollouts. And the question mark is, what does it happen actually to, some of the economies that are really lagging, which is the case of South Africa. It's definitely the case of Brazil. India is another example. So I think this divergence will be one possible factor here, detrimental for the growth outlook in emerging markets.
So, Luis, where do you see the same value? How difficult, first of all, is it to know how these new variants will perform? And of course, a lot of these countries we thought were out of the woods, or certainly India we thought had gone through a first wave, a second wave, and would be looking a lot better than it is now.
Well, that's the difficulty, in measuring how impactful the new variants will be, and we know that governments are trying to answer this question more accurately now. When we do believe that, with the general feedback we had, we do believe that the vaccination rollouts are still very important responses to it. So it's going to be very important to see, an acceleration of these rollouts in the major EM jurisdictions. And before that, if you accelerate the mobility curves, especially cross-border mobility, that can be detrimental. That will pretty much hit back in terms of, new waves, and which is exactly what we saw. Right, and ultimately, it will not allow the governments to release restrictions as fast as many economists or many investors believe. So ultimately, what we want to see the ultimate focus on the vaccination rollout going forward.
Luis, what does it mean? So what are you expecting from the Fed? Will the Fed be patient, and will PBOC be patient? And if that's the case, what does it mean for some of the countries that you cover?
The Fed will be patient. I find amazing that some investors, they seem to be so focused on the whole topic of taper. It's way too early, and the Fed has been extremely consistent on the way it communicates with the market. Talking about patience, talking about a gap in the job markets, and generally speaking, this is very good. This is very positive for EM assets. We know that that tends to drive volatility of financial assets down, and that's exactly what the high-yielding EM wants. So we believe that the second half of the year, once we go through this peak of inflation, will be probably a lot more positive for the EM assets in general, especially on the fixed income side.
So how do you actually play some of the countries that you like the most? So if there's, so what your top trade right now, Luis, what would it be? And do you go through, is it definitely FX, or is there another way of playing it?
It's a balance, actually. It's a balance. We do like the South Africa rand quite a lot on the FX side. In terms of trade exposure, commodities, metal and mining, commodities trading really well. This is all, in a way, filtering through the South African rand. So we do like, short dollar versus the rand, or rand on RV, relative value trades, using the rand as a long leg of the trade. We also like to receive rates in South Africa to go long bonds in South Africa, and there's divergence now. So we do like to pay rates in some low yielding economies, or so low yielding curves. Because why? Because they still trade relatively in sync with the rising and the steepening that is taking place now in the core. So, for example, Czech Republic, this is another economy that we would like to have payers and steepeners. And on the creditor side, it's about growth rebound. It's going to be tentative. For example, we do like Ukraine warrants, and we do like Ukraine Eurobonds, which is, these are bonds, or these are instruments that they do trade very well with the potential outlook of growth rebound in the region. So we try basically to kind of be a balance between growth, equities, and FX, generally speaking, at this moment.
Thank you so much, Luis Costa there. Great to speak to you again. Citigroup Managing Director and Head of CE MEA FX Strategy. Now, alongside vaccination, flexibility has become a buzzword during the pandemic, especially when it applies to work. Employees are demanding more bespoke working arrangements even as they begin returning to the office. Workspace sharing company WeWork says demand is up and it is ready to capitalize on the shifting world of work.
Companies are not looking forward to going back to the traditional way of signing a 20-year lease and setting up these non-flexible headquarters. That's dead. The office is very different today. You know, the biggest or most of our larger customers are the world's most valuable companies who basically are sending us their employees because they don't know, how many days they're going to be working, because they don't know where their business is going to grow. And when you're sitting in the only company in the world that has over 1,000 buildings in pretty much most important cities around the world, the demand for WeWork space today is higher than it was prior to the pandemic. So what the pandemic allowed WeWork allowed to reinvent itself, it allowed to learn how to operate on a most cost-flexible basis. And now you have a WeWork that, like I said before, WeWork should be a profitable company by the end of this year or by the beginning of next year at its latest. And demand for this type of flexible office space is higher than ever. And I think the world is going to redefine in terms of where flexibility becomes the most important part that a company can offer its employees.
I got to go there with the crypto question. Obviously, WeWork last month announced that it would be accepting payment in the form of cryptocurrencies, notably Bitcoin. It also said it would hold some on its balance sheet. Today, we saw Elon Musk come out and say Tesla would no longer be taking Bitcoin over concerns about the impact it has on the environment. Obviously, the environmental impact of mining Bitcoin has gone up significantly over the past few months. Is that the right move? Is that something we're likely to see WeWork follow, or is that just a sort of a reaction to a short-term trend?
No, I mean, the reason why we decided to accept cryptocurrencies was because our customers were asking for it. One of the things that we do with Sandeep is we listen to our customers a lot, and we have to, right? They tell us the type of office they're looking, they tell us the type of setups that they want, and the crypto word came out a lot where employees say, we would like to pay you in crypto. We have accumulated a significant amount of wealth in crypto that we would like to use it to pay for rent, as rent becomes an important part of many companies. So we decided to basically accept crypto, and at the same time, as people pay us in crypto, to us, it's just another currency. It's like we're holding to. We have US dollars, we got euros, we got pounds, we got crypto, we got Japanese yens, we got so to us it makes no difference. And when our customers ask for reimbursement in crypto, we pay in crypto. And we have, we've had some of our customers who are paying us in cryptocurrencies, and we have some landlords who said, "Look, I would like you to pay me in cryptocurrencies." So, the way WeWork looks at it is, we're going to listen to what our customers want from us, and if they demanded that they wanted to pay in crypto, that's why we took crypto as a form of payment.
Do you have a level that you'd be comfortable going to in terms of your sort of total money going in and out in the form of crypto?
I mean, today is a very small part of our business. I think it's the beginning. I think crypto is a mega trend. I think crypto cannot be ignored. And, it's going to grow according to whatever our customers want. If our customers want to pay in crypto more, we're going to accept crypto. If our customers want to pay on traditional currency, we're going to accept form of payment as traditional currency. So to us, this was nothing more than a move to basically help our customers satisfy some of their needs that our customers were asking from. Obviously, our first customer and the large one was Coinbase. Not a lot of people know, but the headquarters of most of the real estate that Coinbase uses is WeWork, and being them the largest exchange of cryptocurrency, they were the first customer to pay us in cryptocurrency.
Well, that was Marcelo Claure, the WeWork chairman and SoftBank COO, talking to Bloomberg's Ed Hammond on the improving outlook for demand and cryptocurrency. Now, coming up, the crypto coasters take another plunge as Tesla founder Elon Musk stays skeptical on Bitcoin. We'll have the latest next. This is Bloomberg. Can you take a picture?
I think Bitcoin will be somewhere between 40 and 55,000 for the next chapter before it kind of builds up enough new momentum to take out that 55,000 and and end the year much higher.
How concerned are you about the short-term volatility being introduced by Elon Musk?
Listen, Elon Musk is an important figure in American business, and certainly in the global retail crypto world, he's a bit of an icon. He was great for crypto when he was positive for Bitcoin. He's caused some issues. I think if you take Elon at face value, though, what he said was he worried that as Bitcoin used more and more electricity, which it will, it could have a negative impact on CO2 emissions. That's true for every industry. And so I think you're going to see a response from this industry, like you should see a response from every industry to say, hey, in this gap of time before all electricity is green energy, which I think is 7-8 years away, we should do something to offset our footprints. And that's in banking, it's in crypto, it's in tech, it's in industrial businesses.
Is it problematic that like one of the hottest currencies is a joke, Doge, and that Elon Musk, who is this like sort of like face of it all, is essentially whipping people into that one and sort of multiplying the jokes? And you have other influential people talk about even other jokes, and that this sort of like, does it make it harder to put on a, basically make the case that there's a serious industry with a straight face?
Well, listen, yes is the answer. I don't want to discredit the Doge community or any of these communities, right? What you're seeing here is a response against the monetary policy of the U.S. and the world, and the frustration people have had with the system. And this young generation has said, hey, we can band together and create our own way of investing. Some of it is frivolous and I think will end in tears. And so we try to steer our clients away from projects that we don't think have long-term sustainability. But it proves something that communities can band together, right? The world has gotten very tribal, and that's not necessarily a good thing. And if you go on like crypto Twitter, you really realize just how tribal it's gotten. One of my buddies made some negative Doge comments, and he got 6 death threats. And so that's not good. But I do think, let's not miss the forest through the trees. Underneath it all, there's a huge revolution going on, run by serious people who are trying to rebuild the financial market infrastructure of this place.
Well, that was the Galaxy Digital Chief Executive Mike Novogratz wearing a suit, speaking to Bloomberg's Sonali Bazek and Joe Weisenthal, taking the long view on the future of digital currencies. Now, staying in the crypto space, Bitcoin continuing a pretty volatile week. That's probably the understatement of the year, losing about a quarter of its value in the past 7 days. Now, the token's collapse comes after Tesla chief executive Elon Musk blasted investors with a series of tweets questioning the environmental impact of Bitcoin mining. Well, joining us to talk about crypto is Joanna Ossinger, Bloomberg's Asia Crypto Tsar. Good morning, Joanna. Also, you also have the best title. We only get people with really good titles on this program. First of all, Joanna, what's the reaction in the crypto community to Musk's statements about Bitcoin?
It's anywhere from disbelief to opportunism. There are some people who almost are angry about what he's said, and there are some people who are even trying to get in and say, hey, Elon, if you don't like Bitcoin, look at my coin instead. So it's ranged the gamut, but one thing that it has done is it's reminded everyone about the volatility of crypto, because Bitcoin and even Ether, the second biggest cryptocurrency, were really rising pretty steadily for a few months there, and that helped build the case for institutions to get in. And now there might be some second guessing of that as everyone is reminded just how volatile it is.
Joanna, so how difficult is it at this point to know where Bitcoin is headed? It was interesting also to hear Mike Novogratz saying, look, it's very tribal. It certainly feels like that when you're on social media and you say something which is a little bit negative, at it. But is there something that will replace Bitcoin as the biggest and the more appealing one?
Well, some people argue that Ether could eventually, but Ether and Bitcoin are very different. Bitcoin is kind of seen as a store of value, and Ether is more like an app store, kind of something where you can build on the Ethereum network. So they do have different use cases, but a lot of people are looking at, say, I think Bitcoin's in the mid 40,000s right now. People are looking at 42,000 and 40,000 in particular as technical levels. They're looking at that 200-day moving average, which is just sitting a little below 40,000. But then people, as Novogratz is saying and some others are saying, they still see Bitcoin rising and making new highs before the end of the year. And while a lot of people say that Bitcoin is in a bubble, and it looks like there was something to that, it's also true that over time, if you look at the 10 years, the 11 years since Bitcoin's really been going, it's risen basically that, over time. So there's something to be said for buying and holding as well.
Joanna, thank you so much. Joanna Ossinger there, Bloomberg's Asia crypto czar, joining us this morning. Now, coming up, Joe Biden calls Israeli Prime Minister Benjamin Netanyahu to tell him he publicly supports a ceasefire in Gaza amid mounting pressure on the U.S. president to shift his stance. The latest next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, President Joe Biden has shifted the U.S. approach to the conflict between Israel and Hamas in Gaza, telling Israel Prime Minister Benjamin Netanyahu in a phone call on Monday that the U.S. now supports an immediate ceasefire. Well, for more, we're joined by Bloomberg's international executive editor, Roz Matheson. Roz, first of all, why is it so difficult, or why is the U.S. taking so much time in actually having a clear stance on this?
Well, that's right. The US has been very, very cautious in its public statements, even as it's been engaging in a flurry of diplomatic activity behind the scene. There's been a lot of phone calls to stakeholders in the Middle East, across North Africa and Europe, for example, and on both sides as well, between the Secretary of State and President Joe Biden making these calls. However, publicly, they've been very careful, saying that Israel has the right to defend itself, and its reactions have not been an overreaction. So far, it's tiptoeing toward calling for a ceasefire. The comments are still not quite there. So far, saying they'd support a ceasefire, but they're not urging or demanding one, at least publicly, and being very careful on that. That probably reflects the desire of the US and others to essentially focus their priorities elsewhere. Joe Biden is grappling with a bunch of very big things at home, including enormous and possibly transformative packages he's trying to get through Congress. To redraw infrastructure, essentially, in the US. He's also dealing with China and Russia ahead of the potential summit with Vladimir Putin in Europe at some point next month. So he's got a lot on his plate. And if you're the one who takes the lead in terms of getting a ceasefire between Israel and Hamas, you then have to own the mop-up after that occurs and making sure a ceasefire sticks.
Roz, at the same time, we're hearing that, Lebanon is again firing projectiles. So it is, how sensitive is the Middle East situation right now?
Well, that's right. There's been another volley of rockets overnight. That's the second or so, at least, in the past week from Lebanon toward Israel. They tend to not cause much damage or anything, but they do remind everybody that there's always the risk to this conflict to draw in other players in the region, particularly Hezbollah, which then draws in Iran. And there are broader issues at stake in terms of the thaw between Israel and Gulf Arab nations, the effort to get an Iranian nuclear deal, the thaw also between Saudi Arabia and the UAE. And all those things are very fragile but very important because they can open up trade and investment and contribute to broader security and peace in the region. There's no talk at the moment that the Abraham Accords, for example, would collapse entirely, but the Lebanon rockets are a bit of a reminder that there are many things at stake here.
Roz, thank you so much, as always. Rosalind Matheson there, Bloomberg's international executive editor, joining us this morning. Now, Bloomberg Surveillance continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz out of New York. We'll have full market checks. We'll, of course, look at all of these media deals. In the last 48 hours, there have been quite a lot of media speculation about tie-ups. We'll talk about AT&T announced yesterday. We'll talk about Amazon potentially buying MGM. This is Bloomberg.
We know that this recovery is going to be a little bit bumpy. We turned off the economy really quickly in the spring of 2020, and we're turning it back on now.
We reopened this year. That may also put, and indeed in the CPI report, it did clearly put upward pressure on prices. Most of this is likely to be transitory.
The transitory word is overused. I think the right word is, we don't know, it's noisy. And the Fed doesn't know.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, good morning from London, Berlin, and New York on this Tuesday, May 18th. Our top stories today. Hooray for Hollywood. Amazon reportedly is in talks to buy one of the movie industry's iconic studios. MGM could help bolster Amazon's Prime streaming services. Did Americans engage in retail therapy? We'll learn today when a number of well-known retailers report, among them Walmart, Macy's, and Home Depot. And it's a Big Short sequel. The investor who made billions shorting mortgage securities now sets his sights on Elon Musk and Tesla. So there's quite a lot going on in the markets. We have these really good stories, especially this fight for content that we've been talking about sometime, and this media M&A really coming at the forefront. Kailey, good morning, first of all, but what else are you seeing in the markets?
Good morning, Francine. Happy Tuesday. It is a green picture in equity markets really across the world this morning. That was true in Asia with stocks broadly higher, but I would note that where the outperformance was in Taiwan, which is not what has been the case in recent weeks. Taiwan's stock index rebounding in a big way, up more than 5%, its best day actually since last March. But of course, that follows a decline of about 10% since last April. Now, of course, it was the chip stocks in particular that were really leading things higher in Taiwan. Taiwan Semiconductor up about 4%. And that optimism in Taiwan really feeding through into Japanese equities as well, with the Nikkei closing higher by more than 2%. I would note in foreign exchange, it is a broadly weaker dollar story this morning, down against everything in the G10 space. That is true as well for the Japanese yen, stronger against the dollar by about 0.3%, sitting at 108.88. As for what the picture looks like here in the U.S., it does look like it will be a firmer open in about 4.5 hours' time. Of course, we did see losses of a few 0.1% yesterday, with big tech lagging. Today, though, it is leading, futures outperforming on the NASDAQ 100, up about 0.8%. In the bond market, Treasury yields going absolutely nowhere, where you're sitting right around 1.65%. And in the commodity complex, I would note gold futures continuing to inch higher. We're right around $1,870 an ounce. Is that just a weaker dollar story? Is that lower, more deeply negative real yields? Or is that because of turmoil in cryptocurrencies, Matt? Because, of course, we have seen a lot of volatility when it comes to Bitcoin over the last week or so. Thank you very much to Elon Musk's Twitter account, but we are seeing some stabilization in Bitcoin this morning. It's just under $45,000. What does the picture look like in Europe, Matt?
Yeah, stabilization at the bottom, right? I mean, basically Elon Musk drove it down and it stopped there. Here in Europe, we are seeing gains in terms of risk assets, equity indexes rising for the most part, as you can see, with the biggest gains in Portugal and Italy, but you also do see gains in Spain, France, Germany, and the UK. If you take a look at the big asset price moves, the euro has to be one that catches your eye. Up to 122.16, that's the strongest that we've seen the euro since really the beginning of the year, since January. The 10-year bond is at negative 11 basis points. The closest it's been to zero, so the closest it's been to going positive since 2019. And then Vodafone posting its biggest drop in over a year. It had fourth quarter results that were strong, but it says CapEx is going to eat into its free cash flow over the years ahead. Goldman Sachs cuts its price target and says, watch out, because free cash flow is going to get hit for 3 years in a row. Francine?
Yeah, 3 years is not nothing. Now, look ahead, or a look at what's coming up ahead. This is a big day, of course, for retail earnings, Matt. We'll get results from Home Depot, Macy's, and Walmart. It could give us a good indication, of course, how the U.S. consumer is feeling and how it's been spending. Now, Euro area finance ministers and central bank chiefs also holding an informal meeting today. I imagine it's all about growth recovery, but maybe talk about inflation and, of course, the vaccination process. And then at 10 a.m. New York time, Dallas Fed President Robert Kaplan takes part in a panel discussion moderated by Atlanta Fed's Rahul Sharma during his bank's annual financial markets conference. So don't miss any of that. Matt, it's very clear that day in, day out, we talk about Bitcoin. That's really captured the imagination of a lot of people in saying, right, because Elon Musk is now, tweet by tweet, changing the course of Bitcoin, what's the other cryptocurrency that will emerge from it?
Yeah, well, I mean, Ether has been the obvious winner of all of the other cryptocurrencies. So Bitcoin, the problem there is it's kind of been seen as a store of value. That's the point. It looks like a Bitcoin, not transactional. And if the value drops by 25% just because Elon Musk puts out a tweet reply, that's a real concern for something that investors would be hoping to rely on, no?
Right. Yeah, absolutely. Now, there's also been a lot of takeaways from the flurry of 13F filings in the last couple of days. Yesterday, late last night, was actually the deadline. Not least Michael Burry, made famous in the film The Big Short. He's placed a big bet against Tesla. So let's get more from Bloomberg's Danny Berger. Danny, this is, one of our top read stories today.
Yeah, and I have to say this sort of bearish attitude towards Tesla from Michael Burry, it's not new. This is the first time we really have gotten details of exactly actions he's taken. But last December, he had tweeted at Elon Musk that he was shorting Tesla. He since deleted his Twitter, which is pretty unfortunate because it was pretty entertaining. At one point, he compared NFTs to magic beans. But that's besides the point. So in this 13F filing, we learned that he had put options against about 800,000 Tesla shares. Now, because of the opacity of 13Fs, we don't know when he put them on, when he may have exercised them, but it's likely he made money from them, considering Tesla has just fallen so far this year, lost about a quarter of its value in the first quarter. Previous concerns he's had about Tesla has a lot to do with valuation, so that might be driving it. Now, in general, in the 13Fs, we did see the shift away from the stay-at-home sort of plays, so we saw a lot of hedge funds dumping Zoom, CrowdStrike, Peloton, maybe valuation concerns there, maybe reopening trades. And then on the other side, the cyclical side, we had people like Warren Buffett dumping a lot of his bank stocks, but adding on Bank of America, whereas D1 Capital also added to bank stocks. So you kind of get this picture from 13Fs, besides the Tesla short, of this moving away from the stay-at-home, perhaps more concentrating on some of these cyclical bets.
All right, Danny, thanks very much. Danny Berger talking to us a little bit about the 13Fs there. More and more news coming out after really the big story, the Archegos story over the weekend from Soros. Now, let's get to media M&A. The race for content is on. Amazon reportedly making its biggest push into entertainment so far. It's said to be in talks to buy the historic Metro-Goldwyn-Mayer MGM Studios, the maker of the James Bond films. It comes just after news of the biggest media merger in years, the tie-up between AT&T's media assets and Discovery. We always use tie-up, merger, combination. Matt Bloxham joins us from Bloomberg Intelligence. Matt, these are just pieces of PR jargon. There's an acquisition or there's not, right? I don't get the obsession with calling these things a merger. What do you think?
Yeah, well, the bankers have got to keep themselves busy somehow, and to justify the fees. But I mean, yeah, whatever you call it. I mean, obviously there's a huge amount going on in the media world right now, and there's a lot more to come. I think it just shows you that if you're going to be big in the streaming game, you've got to be really big. And I think certainly, the Amazon deal is relatively small, only about $9 billion according to the reports. But it's an important step for them because you need to keep content fresh. You need to keep coming out with new films, new shows that are going to mean that your customers still happy to pay the $7, $8, $10 or more a month for your service when there's 3, 4, 5 other platforms that they could be going to. So I think definitely got some good assets there, particularly the James Bond films and some TV content too. So understandable why they're doing it.
Yeah. Matt, I really want to know when the new James Bond is out. Unclear. I've been Googling it all morning, and I still don't have a date. But it seems that in the last 48 hours, we have so much M&A, be it TF1 with M6 in France, be it AT&T. Is this really a fight for content?
Yeah, it is, and a fight for scale. We've seen for years that Netflix spends tens of billions of dollars on content, and you need to have a big customer base to make a return on those big investments. So yes, it's a smaller scale in Europe, but this is why we're seeing M6 and TF1 think about getting together, because the ad-funded business under pressure. They're having to invest in streaming too. The technology is expensive, so you need lots of eyeballs to kind of make those investments pay off.
All right, Matt Bloxham, Bloomberg Intelligence TMT analyst, thank you so much. I do want to take a look at some stocks moving in pre-market trading here in the U.S. And while we're talking about media deals, we of course had AT&T spinning off its media assets and merging them with Discovery. That news coming yesterday, and AT&T shares fell off the back of that news in the Monday session. Those losses are continuing this morning with shares down about 4% in early hours. To the upside, though, we're seeing a meme stock renaissance or resurgence. The likes of AMC rallying yesterday. that continues this morning. The stock could see its 8th consecutive day higher. Shares up the better part of 10% in pre-market trading. And finally, speaking of 13Fs, like Danny was talking about, Warren Buffett's Berkshire Hathaway also adding a position in the broker Aon, and that stock is higher by about 2.25% before the bell, Francine.
All right, Kailey, I think I have a release date, actually, for the new James Bond film, 30th of September, according to Google, here in the UK. But I don't know what happens in the US or Germany. So we'll look into it and give you real news you can use. Coming up, Patrick Armstrong, Plurimi Wealth Chief Investment Officer. And then a little bit later on, we also speak with Ludovic Subran. He's the Allianz Chief Economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, we have been looking very closely at inflation for many months now, and we've been focused really, Kailey especially, on the 5 years. I think Francine has named her new dog that. But I'm looking right now at the 2-year break-evens. They seem to have broken out. If you take a look at this chart, and for those of you on radio, I can tell you it shows exactly what I just said. We've got 10-year and 30-year break-evens here in blue and white. They're coming up to 2.5%. But the yellow line here is the 2-year break-evens, and it is jumping to almost 3% here. So it seems as if, Francine, the markets are expecting inflation to rise sooner rather than later.
Yeah, my puppy 5-year forward is not behaving as well as it should, so I don't know whether it has an indication for the markets or not, Matt, but we're watching that very closely. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, now joins us. Patrick, you're not here to talk about puppies, although we could. We're maybe here to talk about inflation in a second, but if we start off with M&A, there's so much M&A in the media space right now. Is this symptomatic, actually, of what's happening with central banks on funding, or is it just, this certain point in the cycle?
It's both those things. I think there's abundant liquidity. You've got a market that really values future earnings. The only way you're going to monetize content is get with a big player with a streaming franchise, and getting that content is key. So I think everything you just mentioned is coming together. Content is really what's driving streaming, and the market's really valuing those streamings at hundreds of billions. So acquisitions make sense. If you're a big company with a lot of cash and you got a subscale streaming service, you've got to get that content.
Yeah. Are you invested in any of the media names, Patrick? And is it a play actually on possible future consolidation where you could get a premium?
The only media names I've got are Facebook and Alphabet. I think they've got a lot of advertising. You can call them media companies almost, but I don't have any of the content producers or the pure plays on a Disney or a Netflix type companies.
Are those, you think, good inflation hedges, Patrick? I mean, we haven't seen gold performing very well. Bitcoin, if you thought of it that way, has been a little bit of a disappointment recently. Obviously, longer term, it's made you incredibly rich if you were in it. But none of the traditional inflation hedges seem to be working out, although equities is one that, people always talk about.
Yeah, I think equities come with a J-curve. It's a great long-term and hedge against inflation. In the short term, generally inflation precedes higher interest rates. Higher interest rates push down equity prices. Within our equity positioning, we're in shorter duration stocks, which means stocks that aren't trading at crazy multiples. We're in companies that are producing the goods that are creating inflation. So material companies that we've owned, Fortescue, Iron Ore, Freeport, BHP, Rio Tinto, all of those are beneficiaries of the higher prices from commodities. I think you want to own companies where demand is outstripping supply, like chips. We've got a shortage of chips. You want to own the semiconductor companies, the manufacturers of those. And even things like vaccines, there's incredible demand for that. You have some pricing power. The market got spooked when Biden said he wants to take away their intellectual property, but I don't think the EU will allow that, and that wouldn't send the right message for what will happen in the next pandemic. So I think equities do make a lot of sense, especially while real yields are so negative. The risk from inflation isn't bad for equities, it's the interest rates. And you're not getting the big jump in interest rates yet.
Yeah, it doesn't look like the IP idea had a very long life there. I wonder about digital currencies in terms of Facebook. You're an owner of Facebook. They plan to offer or launch their new digital currency DM this year. What do you think about that, and what do you think about the crypto space?
I'm not positive on the crypto space just because, to be positive, Bitcoin would have had to dominate for me. That there's a fixed supply, and then all the arguments on why Bitcoin's a store of value, it can be used for transactional purposes eventually, potentially, but there's no fixed supply of cryptos in aggregate. There's fixed supply of individual cryptos, but every week you're seeing so many new cryptos launched. I don't think we have the winning crypto yet. I think crypto will be part of how we transact in the future. But I think it'll probably be a group of companies, that maybe Facebook is part of it, Apple, Tencent, Alibaba. If all of them agreed on one crypto that they would use, pay their staff with, pay bonuses in, it would be great for them. And it would just dominate all the other cryptos. And while that's still out there, the cryptos that are worth billions and tens and hundreds of billions almost now aren't for me.
Obviously, crypto has seen a bit of a cooling down in recent weeks, at least when it comes to Bitcoin. What also seems to have cooled a bit is that red-hot rally we saw in commodities. I know you like materials as a play, but how long do you expect that strength can really continue?
I think it will continue. You just saw during the pandemic supply disruption. It was just massively curtailed supply. Demand was massively curtailed as well. You've got demand clearly coming back on stream. It's already back on stream for many commodities. And it's a lagged effect to get supply to catch up. And the only way you get that supply is higher prices. So I think commodity prices are going to continue to move higher. I don't think we're going to have the same kind of momentum we've had for the last 12 months. But I do think the path of least resistance for commodities is higher. You've got M2 growing at 24% year over year, massive amount of liquidity, money, and that's feeding its way everywhere into asset prices, commodities, and even goods now.
Thank you so much, Patrick Armstrong, their Chief Investment Officer at Plurimi Wealth, joining us on a number of subjects. Now, coming up, it's day 2 of the Bloomberg Business Week event that brings the magazine to life by exploring the how-tos of technology, culture, and creativity. It's a summit, and today we'll hear from the Vimeo Chief Executive and WeWork Executive Chairman, Marcelo Claure. It starts at 10 a.m. in New York, 3 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg. First word news, and the Biden administration has now shifted the approach to the violence in Gaza. President Biden told the Prime Minister, Benjamin Netanyahu, he'd support a ceasefire between Israel and Hamas. For days, the president had publicly called for calm, but for no end to the conflict. Since last week, Hamas militants have fired more than 3,100 rockets into Israel, while Israel has pummeled Gaza with air raids and artillery. Now, Republican senators plan today to deliver their counteroffer to President Biden's infrastructure plan. The president has called for spending a little more than $2.2 trillion. Senator Lindsey Graham says the GOP proposal could be as high as $900 million. Now, Republicans are opposed to using tax hikes to pay for the spending. And in the UK, more than 2,300 people have been infected with the highly transmissible India variant of the coronavirus. Now, the government said early evidence suggests that vaccines still work against the strain. Meanwhile, an England-wide ban on households mixing indoors was relaxed on Monday. And a stark warning today from the International Energy Agency. The IEA says the world has a choice. It can stop developing new oil, gas, and coal fields, or face a dangerous rise in temperatures. Now, the agency says annual gains in energy efficiency must be 3 times faster over the next decade. There would have to be big gains in solar energy and electric cars. Now, I mean, this was a pretty stark warning from the IEA. This was part of its 2050 net zero emission program. And I have to say, it took me by surprise just because it was pretty punchy in terms of what we have to do now. And you wonder whether, the pandemic is maybe an excuse to do that transition quicker.
Well, did you just see a couple of minutes ago, we got news out from Lamborghini. The Volkswagen unit is now going to spend $1.8 billion on electrifying all of its supercars, including the famous naturally aspirated V12 Aventador. So they're all going to go electric, sadly.
Well, and part of this plan from the IEA says that you can't have internal combustion cars being sold anymore, new ones, by 2035. That is 14 years away, and obviously automakers are taking a step in that EV direction, Francine, but still no new internal combustion cars in 14 years. I don't know if I believe that timeline.
Yeah, I checked, actually. I didn't know how many Lamborghini were sold, but apparently it's about 8,000 a year, Matt. It's good. Don't know if it makes a huge difference, but it is certainly in the right direction. Coming up next, Ludovic Subran from Allianz. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. We're all riled up about James Bond, the new one and then the one after. But let's leave James Bond aside. Of course, it's on the back of Amazon apparently looking at MGM, Matt, and talk about the markets. What is it, Bitcoin or is it M&A that's kind of dominating markets today?
I really think it's M&A. I mean, it's a much bigger issue, right? Because we're talking about many companies that normal people know and trade and own in their IRAs. Bitcoin, I think, is still a separate issue. It's still fairly niche compared to the likes of telephone. You know, we're talking about a company that has only one letter in its ticker on the New York Stock Exchange. There aren't many of those. And then you've got these big media companies, Discovery, now Amazon. I mean, Amazon is worth twice the market cap of all the Bitcoin in the world. So it's a much bigger deal. And of course, they're looking at possibly buying Metro Goldwyn Mayer, which historically is more important than probably any of those others.
Yeah, MGM, the maker of James Bond, hence our James Bond conversation. Kailey, what else are you seeing in the markets?
Well, I think the fact that we're all so passionate about James Bond shows why Amazon maybe wants to make this acquisition to get those assets. In the markets, though, it is a lot of green on my screen. That is true on both sides of the Atlantic. Stocks in Europe higher by about 0.3% at this point, as are S&P 500 futures, with about 4 hours to go until the U.S. opening bell. No action at all in the Treasury market, if I'm being honest. This morning, we are flat on the 10-year yield, just shy of 1.65%. And of course, in the commodity complex, Brent crude is back above $70 a barrel for the first time since March. It did not close at that level in March, so if we do close right here around $70.12, that will be the highest close since May of 2019. Now, as you guys were just discussing, we also have to talk about crypto. We are seeing some stabilization in Bitcoin this morning, and that is giving a lift to some cryptocurrency-tied stocks in pre-market trading, the likes of Marathon Digital higher by 4%, Riot Blockchain higher as well. Of course, another story we've been watching closely is what happens with the ARK Innovation ETF. It has been under immense pressure this year as some of those momentum names fall out of favor, but with a little bit of a rebound in big tech this morning, that is higher by 1.4% in pre-market trading. And then, as we were just discussing, Amazon potentially looking to buy film studio MGM. Shares not getting too much of a bid in early hours off the back of that, but still higher by about 0.5%, Matt.
All right, watching all those stocks very closely, and interesting that they're all green arrows today. So that should show you which direction we're going to move. Maybe the U.S. doing even more than we saw in European stocks, or that we see in European stocks right now. What I've got here is a look at the Fed hike expectations. And for those of you listening on London DAB Digital Radio, I will tell you that the market has moved up its outlook for a Fed hike in 2023. That's the top line here on this chart. That's when we're expecting it to happen. December 2022 Fed futures are still under 25, so maybe it's not going to be then, but the question is, are we going to see enough growth and, maybe more importantly, enough inflation that sticks around, that's not transitory, to the extent that anything isn't transitory? Is that going to be enough to push the Fed into making a move before 2023? Joining us to talk about all this and more is Ludovic Subran, Chief Economist at Allianz. Ludovic, what do you think about the kind of growth that we're seeing in the U.S.? Because there's been some talk with a lot of economic data point misses over the last week that maybe it's not as much of a rocket as some had expected.
Well, I mean, it's very strong, though, and you see that on the jobs in the jobs report. You also see that in the sectors that matter, which are the services sector. Social spending for American households represent 40% of the budget. And, you see now that it's finally being unleashed in part. So not all of the savings accrued during COVID, the forced savings will be unleashed, but part of it is. Especially you look at airline traffic, look at hospitality, vacancies in hotel rooms, mobility trackers. It's actually going very strong. The question is indeed that people are still very precautionary about the future, about the pension, about the future of the jobs, because, we still have half of the jobs lost during the pandemic that have not been recovered. So people are still a bit cautious, but I think the US will hit a solid 6% growth this year. And in inflation, as you know, we still expect more than 3.5% overall annually for the US. So it's quite strong nominal growth. The great reopening is happening, and we hope for that type of great reopening to happen in Europe very soon.
Ludovic, does it mean that actually the Fed needs to be a lot more cautious? Is it transitory inflation? So does it come back to a more normal level, or actually could it push through?
We are in the transitory camp. We look at inflation through three, topics: supply and demand mismatches, and we think that this is what is driving inflation right now. You see it on commodity prices, input prices, the famous semiconductor shortages. This is all something that is, quite normal for post-lockdown economics. So we see that, and if you look at the U.S. data from last week, you see most of the price increases or acceleration are coming from sectors or sub-indices that were not priced before, like airline fares. There was not such thing as selling airline tickets a year ago. So that's normal that you get all of these base effects. So, there is this, supply bottlenecks, there is this demand, wonderful demand coming up. So that's what we think is driving inflation. What we need to look at is wage setting, price setting loops. Do we see a hysteresis, on the wage and price issues? And we don't see that yet. There's still substantial slack in the US economy and even more so in the European economy. But we need to look at that because this is a once in a century type of rebound and cycle, right? But right now we don't see any fears. And the second stuff, which a lot of people are commenting on, which we think is not happening, is monetary inflation coming from the broad base of money growth that we've seen. We don't see velocity of money picking up. So for us, this is the two things we need to watch. Yeah. Is there something happening on the wages? No, because collective bargaining is low, because slack is big and so forth. Is there something coming up on the monetary inflation because of the increased liquidity? No, just because velocity of money is not picking up. Then does it question the impotence of central banks? The fact that the Fed may be against a financial stability wall because they want to, contain, circumscribe, I would say, the debt issues, maybe, but we don't see that yet. So for us, it's all transitory, and we just need to, benefit. Inflation is positive for equity. Inflation is positive for revenue for companies. Inflation is positive for a lot of sectors. So we need to look at the positive sides of this, finally, the economy getting a bit rosier than before.
Ludovic, I know a lot of the focus is also on excess savings in Europe, and you have a great note out on that. How will that develop, as vaccines kind of enter more mainstream and we reach critical vaccination mass?
We have a few examples now of how much of the accrued savings are being spent from China, the US, the UK, Israel. And it's not much, right? It's 1/4 of the savings accrued that are finally being unleashed for consumption and investment purposes. So that means there is still a substantial residual amount of savings. And the question is, what are we going to do with these savings? How are we going to put it to productive use, especially in Europe, for the green and digital transitions and transformations ahead of us? But you just mentioned before I was live, you mentioned this M&A wave. The corporate sector has so much savings, in Europe. The 10 richest companies have accrued 50% more cash on balance sheets over the past year and a half. So there is cash, residual cash from COVID on both household balance sheet and corporate balance sheet. So we should see more consumption and investment if there is confidence. And we should see, on the corporate side, a lot more M&A than we've seen because the economy has been on pause, right? So we expect that on the household side, confidence, and forward visibility will bring a bit more consumption from the cash accrued. If we just get, 5% more of the cash accrued unleashed into consumption, that's 0.5 point of GDP. So this goes really fast, right? And on the corporate side, I expect that there will be a big investment cycle. And we believe that there will be a big investment cycle, maybe more in the US because of the crowding in effect of the Biden infrastructure plan and so forth. But in Europe, I also expect that there will be some. But of course, the forward visibility will be highly dependent on monetary and financial conditions, so what the Fed and the ECB will say, on tax policy, on wage policy. Those two are very important for that cycle because you see protectionism and you see clientelistic, type of announcement being very strong on the headlines, and this could scare companies.
Ludovic, picking up on the wage question, as you said, if I'm here in the U.S., my wages aren't necessarily going up, but I could be facing higher prices at the pump and I could be paying more at the grocery store. And in theory, that could mean I pull back on discretionary spending. So is the recovery going to be dependent on me deploying some of those excess savings? Do you have to assume people are going to do that?
For now, we don't think that you're going to have to pay, that you're going to have compensate the loss of purchasing power due to inflation with your excess savings. But this could actually very well happen in the US, especially as inflation overwhelms its days into 2022, right? And that's also why we're looking at the people on the retail investment, the Robinhood generation, trying to realize their gains to make meet ends, right? So that's going to be quite interesting to see the thirst for liquidity for some of these households that are a bit more vulnerable and whose wages are not increasing as fast as they should, alongside, consumer price inflation, right? So we don't see that happening yet, but to be fair, that would be a nice rebalancing of the economy, right? So I expect, most of the people that have savings on the deposit accounts, inflation will eat that up, right? So they either have to invest, consume, get the nominal signal, or they're going to have to invest that money so that they're hedged against inflation, right? Keeping the cash so that you are led to using that cash to compensate for inflation, that would be sad. And that would be putting you in an even more vulnerable space going forward. So I don't expect that to happen, but that's something to watch, of course. If inflation keeps getting, above 2.5, 3% in the US for 2 consecutive years, for example.
Ludovic, thank you so much. Always a good conversation with Ludovic Subran, their chief economist at Allianz. Now, coming up, it's a big day for retail results. We'll discuss what to expect with Rahul Sharma. He is Neev Capital Managing Director. It's Walmart, it's Macy's. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Abby Joseph Cohen, Goldman Sachs Senior Investment Strategist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, Francine, Matt, U.S. retailers are reporting earnings this week, giving investors another glimpse into the health of the consumer economy. In-store sales are expected to bounce back following the reopening of cities, stimulus checks, and pent-up demand from the pandemic. For more on this, Rahul Sharma, Managing Director at Neev Capital, is joining us now. Pent-up demand from the pandemic, maybe, but for companies like Home Depot and Walmart, they already saw their businesses booming because of the pandemic, so they're facing really tough comparisons. Is the boom over yet?
Well, I think that is the key question. Now, in my opinion, really, what you're going to see is a lot of these COVID winners, they started off benefiting because the government mandated them to allow to remain open, right? When a lot of people were closed, the likes of Depot, likes of Walmart. I think what we're finding is even through this first quarter, business has been very strong, even while everyone else is reopening. To me, that's a clue that these companies have more, the business has more legs than a lot of people thought. And I think that's because, one, obviously they're in a sweet spot, particularly Home Depot as far as the home is concerned, but they're also not sitting still on their laurels. I think what you're seeing is they've used this pandemic to invest behind their business, be it in terms of more digitalization, be it better service to the consumer, be it higher wages to their employees, so they become more sticky. And therefore actually increasing the gap with somebody else who wasn't able to invest and actually found their business shrink and was therefore unable to invest. So I think that gap is growing, but you're absolutely right. I mean, clearly the comparisons are tougher. So from a momentum standpoint, some of these businesses, the likes of Depot, the likes of Target, Walmart, the numbers will optically look much, will not look quite as good as somebody who's benefiting from the big reopening.
Rahul, I was looking at Walmart. I think it bought this like virtual fitting room startup to try and, so people that can try things virtually instead of having to go to the stores. Are margins actually bigger for a lot of these companies if you buy online, or are they smaller?
Well, actually, interesting. It kind of depends on who the retailers that you're talking. Their store business is much more profitable than it is online. It's much more profitable than it is online. And one of the issues, I think, is that until now you had the customer coming in the store, basically browsing, buying a lot of high putting in discretionary things apart from food. Now they're selecting that basket potentially to low quality items that are bulky, more expensive to ship. So they've been playing catch up with Amazon for a very long time. And I think that has been hurting margins for years. That trend hasn't shifted. I think what you're seeing with Walmart is they are still trying to play catch up with Amazon. And they had a good pandemic. They did make some moves, but Amazon is still so far ahead, has so many more economies of scale. And now the other issue with someone like a Walmart is in this pandemic, not only did they lose share to Amazon, they actually lost share to the likes of Kroger in terms of food, in terms of their food business. So I think that, coupled with the fact that wages are going up and they're kind of being dragged into paying more to their employees, that margin pressure, unfortunately, for that business isn't going away. So I think if they didn't see rising margins during COVID, life is getting a bit harder still here.
I can imagine Home Depot had a great pandemic. Everybody wanted to go there. Walmart, of course, also opened during the pandemic, and it's not likely a place you would want to buy clothes, whether you can try them on online or not, Francine. It's more obviously of a food place and a hardware. I'm just saying I don't think that you would like to. I don't know your taste as well as maybe I could, but I'm not sure if you'd be stocking up on blazers at Walmart. Macy's is probably much more your style, and of course they had a much worse pandemic. Rahul, is this a company that's going to bounce back big time once consumers are able to get out into retail stores and spend actual money?
I think there is some of that, Matt. I think if you look at the fact there is pent-up demand, we are social animals ultimately. We do like socializing in big contexts. We like going to stores. So I think you will see, and you've already seen a clue. You had Dillard's last week come out with some really strong numbers. And that was another down in the dumps department store. And I think you are going to see some of that with many of the apparel retailers. I think the question, and in the beginning, I think it will be quite strong because traffic will be strong. You won't need to discount that much to actually bring people into the stores. The question goes, let's say 6 months from now, many of these trends that, as I said, began during the pandemic, casualization, the fact that we all work from home a lot more, don't buy formal shirts the same way, for example. The whole slews of aisles in the big department stores that are just going to be irrelevant or certainly see much less demand for a while. Those issues have not gone away. Even before the pandemic, the likes of Ralph Lauren, the likes of Estee Lauder were talking about re-emphasizing their own stores away from the department stores. Ulta, their own direct channels for the likes of Estee Lauder. I think the issue to some extent for Macy's is the fight to stay relevant. Do they have the right brands 6 months down the road that still makes people want to come in? And the other question in the very short term, obviously, is the big benefit from the likes of JCPenney going out of business. So, capacity generally going out is helping them. But beyond that period, the same issues come back. I mean, are you an attractive format? Do you have the right brands? And the evidence for almost the last 20 years has not been great, quite honestly, for most of the department stores.
But Rahul, thanks very much, Rahul Sharma. Yeah. Rahul, Managing Director at Neev Capital, talking to us about we're going to get a slew of retail earnings coming out. Francine, I feel like Walmart is the place you go if you want a hunting vest. Do you look good in day-glow orange? Is that, I mean duck boots maybe?
As a rule, I kind of tried to buy Italian. I did try and get, so there was like a little sweatshirt with the Cosmo or the planets, which my kids really wanted, from Walmart. I think it was like $5.99, and that to get it shipped to London, it was like $34 extra. So that never happened. So that was my Walmart experience so far. Maybe we go together in Walmart and do a report on it. Now, later today, we'll get the reaction to Macy's results from the company's chairman and chief executive, Jeffrey Jeanette. That's at 3:30 p.m. in New York, 8:30 p.m. in London, and this is Bloomberg.
when you're sitting in the only company in the world that has over 1,000 buildings in pretty much most important cities around the world, the demand for WeWork space today is higher than it was prior to the pandemic. So what the pandemic allowed WeWork allowed to reinvent itself, it allowed to learn how to operate on a most cost-flexible basis.
Well, that was Marcelo Claure, the WeWork Executive Chairman and SoftBank Group COO. He'll be part of day 2 of the Bloomberg Business Week Summit, bringing the magazine to life by exploring the how-to of technology, culture, and creativity. It starts at 10 a.m. in New York, 3 p.m. in London. Now let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance, who joins me. Tom, I've been wondering what you were thinking. So I know you had a day off yesterday, but what you've been thinking about all of this M&A, T-Mobile, after the AT&T deal with Discovery.
It wasn't much of a day off. We were on the phone. I work on the merger all day. I talked to our wonderful Tara LaChapelle about 5 p.m. yesterday. I think her work has just been really industry leading here on the emotion. And the next step here, Francine, is, well, you've got the Amazon percolating MGM story going on right now. Let's go to the chart. And this is what the first thing I thought when I thought of the really bungled opportunity here for Mr. Stevenson, Randall Stevenson at AT&T. This sort of, Francine, is the great divide back to 2015. And it's simply John Legere and T-Mobile versus what they did at AT&T Wireless. And it just is absolutely stunning, the difference that we've seen over 5 years.
Tom, the other thing, I mean, it just seems like the consolidation, today there's talk about Amazon looking at MGM. It just feels like this fight for media content that we've been talking about for 3-4 years is really coming to the forefront and kind of taking over other M&A news.
Yeah, I have trouble with the word scale, but that's what they're doing. They're trying to find scale, and the reason they're trying to find scale is they're not sure there's profit there. So the only way you're going to get to a hope and dream of profit to pay off all the debt and get into the crowded market is to scale up. What does that mean? 1, 2, 3, maybe 4 players, Francine? The jury's out.
Yeah, and then you'll see what happens, of course, to the strategy in Asia. Tom, I'm looking forward to the program, and I know you're also speaking to Eric Adams, New York City mayoral candidate. Our Tom Keene, there, co-anchor of Bloomberg Surveillance, joining us. Now, this is what else we're watching today. I know, Kailey, you're looking very closely at some of these retail earnings.
I am. Walmart, Macy's, Home Depot, all coming up within the next hour or so. Home Depot actually in just about 5 minutes. My focus is really on what the forward guidance looks like, the demand outlook, especially with the effect of stimulus waning, and then also margins. How much pricing power are these players going to be able to exercise, and what does that mean for costs for consumers, Matt?
Yeah, speaking of costs for consumers, Lamborghini was out with some news today. Their $400,000 Aventador, actually one of my favorite cars, probably my favorite car that I've ever driven is the Aventador, and that includes the Bugatti Chiron, is going to eventually go electric. They're going to spend $1.8 billion to electrify these beautiful, beautiful Italian supercars, Fran.
There you go. I mean, everyone is going to try and go electric. Coming up in the next hour, Andrew Hollenhurst, Citi Chief U.S. Economist as well. This is Bloomberg.